Hey option traders, for today's trade we're looking at a bullish option play in iPhone maker Apple. So taking a look on MarketSmith chart analysis, Apple has been trying to move higher in recent weeks as shares cross back above their 50-day moving average. The stock has been in one very long consolidation since the start of this year. Shares initially broke below the 50-day and 200-day lines in April and still remain below the 200-day moving average at this time. The stock's RS line just notched a new high though on the weekly chart, as you can see here with the blue dot on MarketSmith. An important thing to note here is that earnings for Apple are coming up in just 8 days, which could be a major catalyst in the stock's price move up or down. Apple closed near the high of the day yesterday and has been putting in a series of higher lows since late June, which could be signaling renewed strength in the stock. It may be reasonable to assume that Apple stock could move 5% to 6% higher over the next month. So with that thesis in mind, we're going to take a look at a strategy known as the bullish diagonal call spread in Apple. A bullish diagonal call spread is constructed using call options, as the name suggests. It is used when investors expect the underlying stock price to go up. Remember, with options, there are two types of options we can use. There are calls and there are puts. With both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy long or sell short. A bullish diagonal call spread is constructed by buying a call and selling a call simultaneously. This spread is a debit spread, which means you'll pay a premium upfront for initiating the trade. It also means the option that you bought in this spread is more expensive than the option that you sold. Together, these two options create a spread. The difference in strike prices of the calls creates a specified range. The investor can expect a profit or a loss based on where the stock trades within that range. Another important aspect of this spread is that both calls are on the same stock, but they have two different expiration dates. This is also referred to as a time spread. Let's use an example. Say I have a bullish assumption on XYZ stock and implied volatility is low. This could be a good time to put on a bullish diagonal call spread. So say the stock is trading at around $100 a share. To set up this diagonal, I'm going to look at buying a call with a 90 strike and selling a call with a 110 strike. The lower 90 call is considered in the money because if I own that call, it would allow me to buy the stock instantly at a lower price than it trades at currently. This instant profit potential means that the call is trading in the money. The higher strike 110 call is out of the money, given that the option has no profit embedded in it at the time of initiating the trade. Now, both of these call options not only have two different strike prices, but also two different expiration dates as well. The lower strike 90 call that I'm going to buy should have an expiration that's further out in time. The higher strike 110 call should have an expiration that is nearer in time. Investors can estimate the profit potential of this trade by taking the width of the strikes, which in this case is $20, and subtracting the net debit paid. So let's say I purchased the 90 strike call, which expires in November, for $15, and sold the 110 call, which expires in August, for $5. That nets a debit of $10, which is my total cost for the trade. The $20 spread minus a $10 net cost shows a profit potential of roughly $10 per share per contract in this trade. So now that you have a better understanding of the mechanics of this trade, let's take a look at my trading platform and set up a trade here in Apple stock. All right, so to set up this trade, first is always make sure you are under the right ticker symbol, AAPL, for this trade. If you're on Thinkorswim, to make this a little easier, you're going to select diagonal in the spread box here. And then I would just select this expiration date category. We're going to change the second date here, but the nearer expiration term should be August 19th. And we can see the strike price is displayed down here, so we are going to scroll down and look for 155. So we can see this is 155, 150, and we're going to change this lower strike price, but we'll do that down below once we set the trade up. So going to the side of the screen, because this is where we have call options. So we have the trade set up, but we got to make a few adjustments down here. So we want to be selling the 155 call that expires August 19th. And then we want to be buying the 140 call. And that one should expire in September. Two different strike prices and two different expiration dates in the same stock. And just to completely recap this trade, it's the diagonal. We are looking to buy one call option with a 140 strike that expires September 16th. We are looking to sell one call option with a 155 strike that expires August 19th. So for this trade in Apple, we are looking at selling the August 155 strike call option, which will generate around $390 in premium. Then we are looking at buying the September 140 strike call, which will cost around $1,515. That results in a net cost for the trade of $1,125, which is the most the trade can lose. The estimated maximum profit is estimated at around $500, but that can vary depending on changes in implied volatility. The maximum profit would occur if Apple closes right at 155 on August 19th. Again, the idea with the trade is that if Apple stock trades up to around 155, the diagonal spread will increase, resulting in a net profit. A bullish diagonal spread is a good way to gain some upside exposure on a stock without risking too much if that move higher doesn't materialize. One more thing to remember is that Apple is due to report earnings on July 28th, so this trade does have exposure to earnings if held through that date. That could be a risk. As always, remember that if you're new to options, please make sure that you practice with a virtual trading account before risking any real money. And remember that options are very complex and investors can lose 100% or more of their investment. Be sure to check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.